Well, nobody gets everything right when they're trying to predict the future, but I have to wonder how many experts accurately predicted Buffett's retirement this year. Warren Buffett announced that he's going to retire at the end of the year, passing the Berkshire Hathaway (BRK) CEO role onto Greg Abel, the architect of Berkshire's energy business unit, which used to be called Mid-American Holdings and is now known as Berkshire Hathaway Energy, BHE. I actually thought that Buffett would retire sooner. People have spent a huge amount of time over the course of my life studying Berkshire Hathaway and Warren Buffett. For my entire lifetime, investors had a virtually guaranteed way to beat the stock market. All they had to do was buy shares of Berkshire. As a result, for a huge number of investors around the world, Berkshire became a totem of capitalism. Before Berkshire, a lot of people thought of investing as gambling, and most people believed anyone who could beat the market only did so by cheating or stealing, like the 1987 movie Wall Street sought to portray. But Berkshire changed all of that. Its structure guaranteed investment success, while Buffett's personal reputation made investing respectable. The combination showed, beyond any doubt, that capitalism was more credible and more effective than socialism. Unfortunately, since 2000, and even more so since the global financial crisis, Berkshire's track record has become dramatically less consistent. Most investors simply don't realize the enormous impact that Berkshire's investment in Apple, AAPL, has had on Berkshire's success. Berkshire made a bet-the-company investment into Apple, buying 1 billion shares between 2016 and 2018 for around $36 billion, a stake equal to more than 10% of Berkshire's total equity. It has now sold most of that stake, around 700 million shares, for after-tax gains of around $60 billion. It continues to hold 300 million shares, valued today at around $70 billion, including around $6 billion in dividends. The total return on this investment over the last decade was close to $125 billion, or more than 20% of Berkshire's total equity today. Buffett, of course, deserves enormous credit for making this outstanding investment. I'm certain that is the largest profit ever made from a bona fide outside investor via common stock. And if you look back across Buffett's entire career, you'll find other similar bet-the-company investments in common stocks. In the 1960s, he put 40% of the Buffett Partnership's assets into American Express, AXP. In the late 1980s, Berkshire invested $1 billion into Coca-Cola, KO, a stake equal to 20% of Berkshire's equity. Buffett was, without a doubt, the best common stock investor who ever lived. The trouble today, though, is that Berkshire has become more and more a holding company with 180-plus operating subsidiaries. And, as a conglomerate CEO, Buffett is an abysmal failure. In Friday's Daily Journal, I mentioned how poor Berkshire's investment track record has been, except for Apple, since the global financial crisis. What's most interesting to me is how Buffett's track record when it comes to large, whole company acquisitions has been uniformly bad. There isn't a single instance of success. Since the financial crisis in 2008, Berkshire has made 6 major acquisitions. Precision Cast Parts, $32.7 billion, BNSF Railway, $26.5 billion, Pilot Flying J, $14 billion, H.J. Heinz, $12.1 billion, Dominion Energy, $9.7 billion, and Lubrizol, $92 billion. Total initial invested capital, over $100 billion. Subsequent capital investments into these businesses have been immense. Capital investments at BNSF alone have been over $50 billion, and Buffett has put another $35 billion into more windmills at BHE. As a result, over $200 billion of Berkshire's equity, about 30%, resides in these 3 business units, BNSF, BHE, and Berkshire's manufacturing, service, and retailing (MSR) unit, which Precision Castparts makes up. These investments dwarf the size of Buffett's common stock investments in the same period. Berkshire has become a conglomerate, not merely an insurance company with common stock investments as it once was. And not a single one of these investments has produced a market-beating return. Here's their annualized returns versus the comparable S&P 500 return. A big part of the problem has simply been management. Over the last decade, BNSF has notably underperformed its rival, Union Pacific (UNP). Geico was, until Todd Combs took over for Buffett, dramatically losing market share to Progressive (PGR). Even worse, Buffett presided over huge write-offs at both Precision Castparts, $10 billion, and Kraft Heinz, $15.4 billion. The biggest management mistake is yet to be accounted for, at least publicly, in Berkshire's balance sheet. That is Berkshire Hathaway Energy. BHE has been a disaster. Buffett has invested more than $100 billion in capital to build the nation's largest electrical power company. In June 2022, the executive who built the business for Berkshire decided to sell his 1% stake back to the company. Buffett paid $870 million in cash, which therefore valued BHE at $87 billion. To that point, Berkshire had never taken any capital out of BHE, not a single dividend, not one penny. So after more than 20 years and $100 billion, Berkshire's actual return from that investment was zero realized gains and unrealized losses of perhaps $20 billion. The guy who built that business, Greg Abel, is now going to run all of Berkshire Hathaway. That sounds like a terrible idea to me. What's worse, subsequent to Abel's sale of his BHE stake to Berkshire, liabilities relating to the 2020 wildfires have mounted and are now expected to cost BHE something between $20 billion and $40 billion. When Berkshire bought out Walter Scott's estate, 75.2 million shares of BHE at $650 per share, the deal valued BHE at $49 billion, a decline of 43%. That valuation implies that Buffett has lost about 50% of the $100 billion he's invested into BHE, a loss that, if recognized, would wipe out 8% of Berkshire's equity. What's so frustrating about these holdings is that over the last 25 years, as Buffett invested more capital into regulated utilities, so many of the world's greatest businesses have gone on sale. In the aftermath of 9/11, during the financial crisis, 2009, during the European debt crisis, 2011, during the oil bust, 2015, and most recently, during the COVID panic, 2020. Many people continue to believe that Berkshire has a critical role to play in setting a great example of what can be achieved with investing and capitalism. Painting that picture requires having access to all of the world's best businesses, virtually none of which ever come up for sale in their entirety, but which sell, in small parts, every day on the world's stock exchanges. Berkshire Hathaway shouldn't own a railroad. It should own shares in the world's 3 best railroads. And the leader of Berkshire Hathaway should be able to constantly steer its portfolio toward the best investment opportunities as they emerge. Holding huge, low-quality businesses forever makes no sense, especially when your CEO is the best investor who ever lived. If Berkshire wants to remain relevant going forward, it must divest its asset-heavy, low-returning businesses, BNSF, BHE, MSR. Doing so would dramatically revalue the remaining equity higher, while allowing these slow-growth businesses to become debt-financed, increasing future returns for those companies. That's what will happen eventually. The sooner it happens, the better for shareholders. Buffett should be wise enough to recognize these mistakes and to encourage his successor to set them right. One more thing. People often wondered why Buffett didn't speak out more strongly against our government's gross mismanagement of its budget. Do you believe that Buffett wanted higher inflation because it would have benefited Berkshire Hathaway? I don't know. However, like others, I wish the icon of capitalism had been willing to encourage better financial management from Washington. He could have done so in a very nonpartisan way, and I think it would have helped warn more Americans what would inevitably happen to their savings and the real value of their wages. He did offer a final warning to every American. I hope you will heed it. Buffett said, "We are operating at a fiscal deficit now that is unsustainable over a very long period of time. We don't know whether that means 2 years or 20 years, because there's never been a country like the United States. But you know, if something can't go on forever, it will end." To quote the famous economist Herbert Stein, "We are doing something that is unsustainable, and it has the aspect to it that it becomes uncontrollable. You just give up on it." Paul Volcker kept that from happening in the United States. We came close. We've come close multiple times. We've still had very substantial inflation in the United States, but it's never been runaway yet. That's not something you want to try or experiment with because it feeds on itself. So I wouldn't want the job of trying to correct what's going on in the revenue and the expenditures in the United States with roughly a 7% gap when probably a 3% gap is sustainable. When the further you get away from that, the uncontrollable begins. I think that it's a job I don't want, but it's a job that should be done. And Congress isn't doing it. I'm going to quit while I'm ahead.